Hello and welcome to our weekly wrap-up. This is where we take a look back over the last 5 days to see what has moved or shaken the markets. Joining me on the line today is Michael Van Dulken of Accendo Markets in London. Now Michael, let's just start with the beginning of the week and the Italian elections. The only real achievement came from comedian Beppe Grillo as his five-star movement group snatched 25% of the vote. How did the markets react at the time, and what are you expecting going forward?
Yeah, the reaction was one which the markets didn't take to the news well. It was a surprise result to see so much support for the traditional parties, if you like, and it was a clear rejection of the austerity being imposed on the nation and the reforms, which is not great for a eurozone which is still both struggling from the financial crisis. And the questions arising from the result are things such as, how long would the attempts at a coalition being formed go on for? Will anything useful emerge? And do we go to a second round of elections, as we did in Greece? And while we didn't have a more drastic result in Greece and a full rejection of austerity, that is still a possibility with Italy. Moving on from that, we've also got in addition the issue of the ECB's backstop. Now that's been one of the cornerstones of the rally since last summer. And what happens if an eventual winner or coalition formation in Italy says no to reforms, and thus conditionality of that backstop being able to be used? Do we end up seeing a worsening of the crisis? Do we have the contagion rearing its ugly head and impacting neighbouring Spain as well? However, amongst all that, the country was still able to raise money this week at what is still, sustainable yields. So it was an interesting week for Italy, to say the least.
Now, earlier this week as well, Fed boss Bernanke gave his testimony that seemed to will away almost all the pain from the markets. Meanwhile, the Bank of England pointed to negative interest rates as a policy alternative in the UK. Your thoughts on these two?
Yeah, Bernanke really rescued the markets from the fears they had that QE's days might be numbered. So he put us really at ease after last week's FOMC minutes, which alluded to the possibility that QE might not be here to stay. So his more accommodative rhetoric and clear message that the economic situation in the US still warrants QE for a good while longer was really what markets wanted to hear. The rally we've seen since last summer has been founded both on the help from Draghi, but as well as Bernanke's QE3, on the basis of easy money, easy policy being a prop for risk. And that really did provide, as I said, put markets at ease after their fears of last week. And back in Europe, Draghi did the same by saying there was no intention of tightening policy while inflation is below target. And while January came in kind of on target at 2% consumer inflation, February, the number of February estimate came out this morning, and that was, well below. And so there'll be, that will again have put markets at ease in terms of the ECB's not going to do any tightening, and Draghi was clear that he is still far from implementing any exit strategy from the easy policy that's been put in place. With the Bank of England, this negative interest rates thing, I think it got a bit too much coverage, really. I think it was mentioned as a policy alternative, and I can't see us anywhere near that, quite frankly. While there is while there is still the possibility of benchmark rates being cut, negative interest rates for the banks is something which is in existence elsewhere. But it really is if there are no real alternatives. So I don't see that gaining any traction soon. But it's interesting to see how the briefest mention of such a radical policy gets a lot of coverage and gets the markets excited.
And just bringing us up to date, today on Friday we've seen poor Chinese manufacturing data this morning, along with pretty dismal UK data. Talk us through these if you could.
Yeah, the Chinese manufacturing is an interesting one because it's still above 50, so it's still growing, but that growth has pared back a bit, and that's seen some people put that recovery story theory that bring it back to the fore and say, are we slowing up again after the bit of a bounce? In fact, yesterday I think we had the Chinese business sentiment actually jumped quite a bit, which provided a boost. So it's still a bit volatile in terms of data from that area. And then we followed on Europe with some very mixed PMI manufacturing this morning. Germany is still okay, but the Eurozone is still under pressure. It was, amongst the periphery, we saw some less bad news rather than better, with Greece and Spain surprising to the upside. But then we had Italy coming out with some nasty unemployment figures, which are the worst, I think, since records began back in the early 1990s. And that may go towards, coming back to the Italian election situation, almost reinforcing that rejection of austerity and the political deadlock. So again, not good news to see from Italy. And then on the Eurozone as a whole, the kind of mixed and muddied data is not great. We have recently seen sentiment data being better than growth, so this PMI is not, it by no means surprised too badly both to the upside or to the downside, but we're still just kind of bumbling along. If anything, the big surprise came from the UK, where we fell below 50, which is not great, with Mr. Osborne's budget coming up in a few weeks' time. The manufacturing sector may be pointed to as another weakness. What kind of measures is he going to propose to get that going? So, the UK GDP was confirmed as negative for the Q4 for the second estimate. Although there was a bright spark with somebody pointing to upward revisions to prior months, or quarters rather, having meant that we never really were in a double-dip recession. Therefore, we find it very difficult to go into triple-dip recession. So, some silver lining if you want to look at it in that way.
Just quickly before we run out of time, Michael, President Barack Obama has until midnight tonight to make a decision on $85 billion worth of cuts. Is this the so-called fiscal cliff part 2?
Yeah, big day for the US, of course. It's D-Day for the budget sequester when the government spending cuts kick in. We're not seeing the weakness in the US indices and in the futures too much at the moment. They don't kick in till midnight. Are people wondering whether we'll see another last-minute reprieve, as we did with the fiscal cliff near the end of 2012? Are we a bit more thick-skinned about it all? It's certainly not something the US needs to see when its growth is still in the doldrums. But it certainly seems as if it's been taken a bit better, and it's not something to be taken lightly. But the market seems to be taking it quite well. It's a big cut in government spending, $85 billion, and it could have some wider impacts. But it's interesting to see the markets are taking it well, showing that there is still an appetite for the markets to still trade higher.
Okay, that's all from me. I'll be back next week to bring you further interviews and updates. But for now, have a great weekend. Goodbye.